everyone. Thank you so much for joining. And sorry for the slight delay. We had some technical difficulties, but thank you so much for tuning in. We will welcome you to upcoming webinar, Portfolio Management in the Volatile World, Building Long-Term Resilience, brought to you in partnership with Marcus Evans and Kappa Capital. Before we begin, I would like to cover a few housekeeping items. As you can see at the bottom of your screen, a multiple application widget that you can use. All the widgets are resizable and movable, so please feel free to move them around. If you have any questions during the webinar, you can submit it to the Q&A widget. We'll try to answer as many questions as possible. However, if we run out of time, we'll make sure to answer to you by email. You can also have access to different resources using the resource link, or if you have any difficulties navigating further, just click on the help widget. At this point, I will briefly introduce our moderator, Anders Winter, Director of Kappa Capital. Anders, you can take the stand.
Hello, good afternoon. Thank you very much, and welcome to this webinar hosted by Marcus Evans and Kappa Capital. My name is Anders Winter, and I am a director for Kappa Capital. As mentioned, the topic of this webinar is portfolio management in a volatile world, how to build long-term resilience. We're set for an hour's duration, and I hope we can make it as interactive as possible. So if you have any questions, then please just post them in the chat, and we'll try our best to answer them. So now I would like to introduce our esteemed panel members joining me today for this discussion. So panel, I would be grateful if I could ask you to introduce yourself to the audience, perhaps going from left to right, starting with you, Alex, if that's okay.
No problem. Thank you so much, Anders, and thank you for having me. My name is Alex Fellman. I'm general partner of Fellman Family Office. We're a single family office headquartered in New York City. I play two major roles with our group. One is, even though we're headquartered in New York, I'm personally headquartered in Riga. So I lead up the European branch of what we do, sourcing from the continent, representing our family on the continent of Europe. And then my background is actually in biochemistry and the commercialization of science. So I'm leading up our tech, innovation, venture-related investments for the group as the lead. And in addition to our own family office, we have a multifamily advisory group called MSF Capital Advisors, where we work with 40 families around the globe and acting essentially as a corporate venture capital as a service. So we help families with strategic transactions that fit into their core operating businesses. And I'll leave it at that.
Great, thank you. Moving on to Ian.
Yeah, good morning. Oh, yeah, very early morning for those in the States. My name is Ian Morley. We run a single family office. We're based out of London, Italy, and the Middle East. I work together with my two sons who are much cleverer and smarter than me. And my background is in primarily law, then hedge funds, and I founded AIMA, which is a global hedge fund traded industry, we built up a hedge fund business, which we sold, and then we built up a wealth management business, which we sold, and then no one would employ me, and I didn't want a job. So we set up the family office about 16, 17 years ago, and we work with other families and also directly ourselves. It's a very broad range. We go from care homes to Islamic finance.
Thank you very much, Ian. Much appreciated. And moving on to Alexander.
Thank you, everyone. I run a private investment office based in Geneva. We act as a strategic fiduciary partner to a global leading single and family office, but also endowment and institutional allocator. Our value proposition is defined by, I would say, three synergic division: outsource CIO with the focus on hedge fund, strategic investment advisory, and alpha engine. My background is I'm an econometrician and former portfolio manager of a long-short systematic strategy.
Thank you, Alexander. And then last but not least, moving on to Todd.
Thank you, Anders. My name is Todd Schoenberger. I have two roles. I am the CIO of Single Family Office Crosscheck Management, which is located in Washington, D.C., and I also oversee the firm's media division, as well as our proprietary business network, BTT. And I'm happy to be here. Thank you for having me.
Great. Thank you very much, Todd. Much appreciated. So we prepared a number of questions for our panelists, which will hopefully provide a good discussion on the topic of this webinar. But before this, I would like to just briefly introduce Kappa Capital and also provide a few initial observations that can perhaps frame the discussion. So Kappa Capital was founded in 2016 in Denmark. We are a fixed income hedge fund specializing in Scandinavian fixed income markets, where we use the yield spread between Nordic mortgage bonds and government bonds to deliver an attractive duration neutral return. So briefly, just to set the scene for the discussion. So the investment universe available to sophisticated investors has obviously changed substantially over the last 2 decades. So in addition to the traditional asset classes of equity and government bonds, there is now a broad suite of investments available within alternative investments, so hedge funds, private equity, etc. Credit investments across investment grade, high yield, and structured credit, and not last but not least, infrastructure investments have been added recently. All of these new asset classes have a range of advantages and some disadvantages, but they allow for the creation of a more diverse and robust portfolio. So one of the reasons why investors have reached for these new asset classes is obviously because the correlation between the traditional asset classes of bonds and equities doesn't always work in the way that we would like it to do. And specifically, obviously, the negative correlation that benefits the diversification for these two asset classes changes over time, and not least it changes with interest rates levels. So obviously, some of the alternative investments have been around for many decades, such as hedge funds and private equity. But other asset classes have seen a more recent and more dramatic development, such as, for instance, private credit. So this chart here shows the development in private credit over the last 10 years. As you can see, it's been rather dramatic, and it shows how important this asset class has become over the last few years. Just to highlight a few of the key issues, obviously the very short selection, but some of the ones that I think are relevant in the shorter and longer term. So short term, one can obviously mention the valuation and liquidity of private equity and credit markets, as well as the price currently achieved for both equity and credit investments. Longer term, there's obviously plenty of opportunities and challenges for investors to consider, including, of course, how the economies and the labor market will develop, what impact the fiscal stimulus that we will continue to see will have, and of course the impact from AI, which we are only just starting to see in practice. So with these few words, I would like to start with our first question for our panel. So the first question that we would like to ask is, in today's environment of persistent volatility, how are you personally redefining what portfolio resilience means? How has that definition evolved compared to pre-2020 assumptions? And perhaps, Ian, I can ask you to take the lead on this question.
Sure. No, thank you very much. It's complex, but it's a dynamic situation. I am responding at the moment to a whole range of external and personal factors. One is my own personal age. So I'm going to turn 75 this year. So when people come and ask me, would I like to go into 10-year private equity investments, my answer is generally no. I'm not looking at anything which has got a horizon of more than, say, 3 years. Then there is another factor. I currently live in England, where I'm a citizen and taxpayer, and I live in Italy, where I'm a resident and also a taxpayer, and neither of them have very good tax regimes. And I am fearful, particularly in the UK, that the tax regime is going to get more onerous, and I can see things coming which are going to be very difficult to avoid, which is going to be tax on physical assets like property, will become an annual tax. And then I expect that to expand into total portfolio tax, so your total wealth, because I cannot see a government which has huge demands to meet, particularly in the area of care and medicine, and yet will not, cannot, for various reasons, raise the standard taxes. So they're going to go around the corner the way they've done it so far, nasty, insidious taxes, but eventually it's going to come down to straight wealth taxes. So that guides me. Then the third factor, which I think is a combination of three cumulative factors as far as I'm concerned. One is 9/11. The second is the crash of 2008. The third is COVID. And the fourth is the restructuring of the power base in the Middle East. As a consequence of all of those, I have taken a very short-term and slightly dystopian view of the future. Therefore, what I'm doing is I am trying to sell everything I have. I've reduced my property portfolio down to everything except that which I live in. There's still some to go. I am trying to sell out of all of my private equity. I have gone very liquid and I've gone very defensive. By defensive, I am mean precious metals to the point of coin-based precious metals. So I don't want to lump huge amounts of gold around, things that people will actually trade. And digital investments, although there is a risk that the whole system could crash down, the whole digital Wi-Fi system could crash down. But I'm on that basis. And then anything that I can live on or with. So a farm where I have my own water supply, my own electricity supply, my own food to eat. I'm in a dystopian view at the moment that it is about preservation, and I have dumped all the classic standard academic concepts that normally apply in terms of portfolio management. Now, some things I can't get out of because I'm in them for the long haul, but essentially that is how I'm dealing with the volatility. If I can't pick it up and run with it, then I'm probably not going to buy it.
Wow, thank you very much. That's certainly a very interesting perspective on things. Alex, I don't know if I can ask you to add your views to this particular question.
I think it's quite interesting because I'm reflecting on my views compared to what Ian just said, and let's say I am personally somewhat, let's call it short-term pessimistic and long-term optimistic, if that makes sense. And very much so with the way that we're investing is we're investing with, I would say, a minimum of an 8 to 10 year time horizon. And within an 8 to 10 year time horizon, most of the short-term, let's say, volatility you see in the market tends to cancel itself out. It tends to be noise over the long run. Not to say that I think some of the things that Ian brought up are, let's say, potential things that could have long-term effects in an 8 to 10 year or longer time horizon. I think he brought a couple of key points there, but I think a lot of it tends to be noise and irrelevant. And I think there tends to be maybe 1 to 2 things a year, if that are like, okay, this makes me really kind of reconsider the kind of my long-term outlook of what's happening in the world. And most everything else is stuff that we ignore. And I think for us, one way of looking at it is, let's say we have our kind of day-to-day needs, and how do we figure out how to make sure our day-to-day needs are met. And then we have kind of, when I tend to think about our portfolio, it's what are we doing for the long term? What are we doing more towards multi-generationally? And that's how we kind of balance it out of, I think you run into problems when you, let's say need your long-term portfolio to fill your short-term day-to-day needs. I think that's when you start to get yourself in trouble. At least for us, it's not really designed that way. So let's say, being more specific, right? We own and run a couple of businesses. We have other cash flow generating things like property. Like that's more designed for our day-to-day needs to be met. Whereas, let's say our investment portfolios, and we're quite heavy on direct investments and kind of illiquid investments, but particularly because our time horizons are 8 to 10 years, right? If you need to sell that out, tomorrow, we might be in trouble. But the whole point is that part of our portfolio is not designed for us to sell it out, to need to sell that out tomorrow, right? It's designed to hold on and kind of be able to kind of ride the waves and kind of pick our moments when we feel it's appropriate. Yeah, I think that's where I'll close for a second.
So when you think about when you, Alex, you think about portfolio resilience, you're really thinking about what will sort of preserve and grow your portfolio over the next 8 to 10 years, as opposed to not ignoring, but perhaps paying less attention to the next 12 months. Is that sort of roughly summarized?
Yeah, I would say that's one way to summarize. I think it's also right. It's sort of understanding, taking in the new information, and does that update my kind of hypotheses and strategies? And if I kind of still believe the underlying assumptions are true, then I will continue as normal. If I believe that this kind of actually fundamentally changes one of the underlying assumptions, then it becomes like, okay, maybe we need to update our strategy and then kind of adjust our portfolio appropriately. And I think being maybe a bit more specific, 2 topics I think that are quite top of mind for us right now that we could foresee having kind of a longer term impact would be the impact on AI, and how that's changing, especially with my personal focus on tech, how that's changing the tech ecosystem, how that's changing kind of the larger economy. I mean, most of the larger companies right now in the economy are tech companies. We believe this is going to have an actual effect. And at least for me, Ian kind of touched on this, kind of some of the geopolitics. But one of the things I'm thinking more and more about, to me, it kind of seems like the US dollar is starting to lose its kind of role as the world's global reserve currency. I think that will have a big effect. And I think that's connected to one of the things that Ian was saying about there's becoming kind of a reshuffling of the kind of global political order right now. And I think the US's role as the global reserve currency is kind of a consequence of that, is now as kind of the new balance of power is shifting. And we'll see how that plays out. Economics is kind of, I would argue, is kind of downstream of those geopolitics.
Great. And I think with your mention here, Alex, of the role of the US dollar going forward, I'm probably just going to have to bring in Todd for a quick word here. Todd, how do you define portfolio resilience, and specifically on the US dollar? What's your view there?
Well, I think I'll get to the dollar in a moment, but before 2020, resilience was really defined as surviving an equity drawdown. I mean, because we always had bonds that would save the day. But I think now the way we look at resilience is we define it much more broadly. We're going to look at this as how can we because we've seen periods, as everyone on the panel knows, we've seen periods of stocks and bonds selling off at the same time. And that's because of inflation shocks, US dollar, for example, and maybe concerns there. So now we look at it, we try to define it in 3 different ways. We look at multiple diversifiers, we look at liquidity, regime awareness. So we have to look at our own portfolio at Crosscheck as really being able to survive geopolitical events, policy changes, inflation shocks. And so it's not just about the equity side and surviving those downturns. And I think that's the real change, at least in this decade, for portfolio managers and CIOs, because now they're not just looking at one frontier. You have to be positioned to protect yourself across multiple areas. And that really has been a game changer, because there's a balance of trying to balance protection with efficiency. And that's the real issue. On the US dollar, I've been hearing that for a few decades now, that the dollar is just, and I can't help but think that a lot of that has to do with the current administration, issues that are going on in Washington. So I know, being in DC, we hear that quite often, but it's still the world's we're dollar denominated, commodities are dollar denominated. Nothing's going to change there anytime soon.
Great, thank you very much, Todd. Really appreciate it.
Can I come back on that, Anders, a second?
Yes, yeah, of course.
Anders,
Of course.
So a
Of course.
couple of comments on those things. I think being liquid is a very good situation because we have a global crisis without a global economic crisis. And sooner or later, we'll have a global economic crisis. And when that happens, the extremism of the political reflections around the world will get even sharper than they currently are, and the value of assets will crash. So therefore, if you're liquid, I think the opportunities are going to be enormous. Going back on the dollar, the United States dollar is the world's reserve currency. And when you print your own debt, you can almost do it without limitation because you own the printing presses. When you're Brazil and you issue dollar bonds, you've got a problem because you've got to buy them with your own currency, which is not very stable. The history of the world, going back to the Persians, the Greeks, the Romans, all the great empires, including now the sadly lost British one, is that when they start to devalue their currencies, it's the beginning of the end of their control. No one's going to ring the bell, but the United States is currently being saved by the AI phenomenal growth. Otherwise, they are doing enormous economic harm to themselves by the behavior of the current administration. If there was any alternative to the dollar, which there isn't, because you've got to have a free exchange currency and all of the others are controlled by autocratic systems, the dollar would be under stronger threat than it currently is. But ultimately, all empires fall. The American empire has been more economic than geographic, unlike the UK one. But at some point, the dollar will come under that change. And when it ceases to be the world's reserve currency, there will be huge problems because America will not be able to finance its debt.
Got it. Thank you very much, Ian. Very somber words, but certainly well reflected ones. So thank you for that. So just briefly moving on to question number 2, and I don't want to stop the discussion on each question. It's just to keep within time. So question number 2 is, how are CIOs and portfolio managers rethinking strategic asset allocation in response to higher inflation uncertainty, shifting correlations, and more frequent macro shocks? And I have to say, we did this question before the most recent events, but I think they only highlight the importance of the question. Alexander, I don't know if I can ask you to have a stab at what you think about this question, please.
So just a couple of points relating to the last question. To me, I think we are much more constructive. I think we should rethink, portfolio construction today. Why? Because of course, the world is completely, and structurally not stable. And that was the assumption, before we had for a diversified portfolio with equity and bonds. Okay. So we believe we're entering into a world of uncertainty. And, for many years, institutional investors could rely on a very stable framework. So inflation was contained, globalization acted as a disinflationary and stabilizing force. Central banks were probably predictable enough. And again, the classic equity bond diversification model did much of the heavy lifting. So that word is fading for sure. What we're dealing with now is not simply a more volatile cycle, but we're dealing with a deeper regime shift. And to framing that properly, I think of the concept of reflexivity is very useful to add in the context. Why? Because in today's environment, price do not merely reflect fundamentals, price, but also policy, liquidity, and investor behavior interact with one each other. And in many cases, these shape the fundamentals themselves. So in other words, markets are no longer passive mirrors. They are active component of the system. And that has profound consequences for strategic asset allocation. So some of the assumptions that underpin, institutional portfolio construction for decades are being challenged. Of course, we said it again, but the stability of the bond equity diversification, the stationary of correlation, and even the idea that liquidity it's simply there unless there is a shock. Okay, so today liquidity itself is conditional for to me. It depends on funding stability, but also balance sheet capacity, collateral mechanism, and confidence in the market structure. So this is what I wrote, to my clients, in January, that we're witnessing the dissolution of globalization as a stabilizing regime, So this is not just a geopolitical statement; it is an allocation statement. So geopolitical risk, has become structural. Okay, so is no longer a temporary exogenous shock that we can treat at a side, scenarios. Is directly impact, capital flows, market action, but also industrial policy, inflation dynamics, and country risk premia, in a way. Second point, liquidity has become conditional. So if you look at the repo, if you look at the mechanism of the treasury basis trades, what become clear is that financial stability is more fragile than headline volatility might suggest. So what's next and how CIO must behave in terms of I would say strategist of capital. So in practice, I think the role of the CIO should resemble of a way of connecting the dots. Okay, so the CIO responsibility today is to integrate signal that appear, I would say, unrelated. So monetary policy, credit condition, geopolitical shocks, liquidity dynamics, but also, to me, is very important, the market microstructure, and link them into a current, casual framework explaining how, the asset allocation will function. So this is the way of thinking we have. So we really want to look at a set of less like a set of isolated markets and much more like a machine, of interconnected feedback loops where policy, decision influence liquidity, liquidity affect prices, and asset price feed back into financial condition. So this is the way we think. And we should really understand not just what is happening, but more what is driving what. Okay, so for example, if we have an inflation shock, that lead to central bank tightening raise, real interest rates, and higher real rates, compress valuation across equities, but also credit and private markets. So the liquidity conditions deteriorate and forcing deleveraging across portfolios. So we need to understand all those aspects in order to have a coherent and consistent, asset allocation across the liquid markets. So there is a lot of opportunities, today. For example, if we look at the dispersion across U.S. equities, you look at the S&P dispersion index that currently trade, around 32, 34, you have a level where there is certain strategy and certain specific strategy that are very interesting, like relative value, like dispersion strategies, where correlation between, individual stocks remain very low. So there is, if you look at, the average daily volatility of single stocks is around 1.7%, and is more than twice one of the S&P, which is around 80 basis points. So there is opportunity, and there is positive volatility within certain strategies. Of course, you have to have experience. You have to be a specialist for sure, and you have to go to search where there is the right pattern to catch those inefficiencies. So on our side, we look a lot of QIS strategy um, within the equity space, in order to bring some decorrelation to our actual portfolios. We look at the hedge fund for sure, and within certain strategy. But I think there is a lot of opportunities today, that could combine the liquid and the illiquid space going forward.
Great, thank you very much for that, Alexander. Lots of very interesting observations there, especially on the current level of correlations and what that means for opportunities. Anybody who want to add anything to Alexander's observations?
Yeah,
maybe perhaps.
If I could, Anders.
Yeah.
Correlations are interesting. They tend to work during periods of tranquil markets. I wrote a book about 20 years ago, 100 Laws of Business and Fund Management, and one of my laws of correlation was the only thing that goes up in a down market is the correlation of your non-correlated assets. And the reason that correlations fall apart during volatility is because all standard analysis goes out of the window, because when the margin calls come in, you sell what's most liquid, irrespective, to get the money to cover yourself. So that kills all the correlation analysis, which is a problem when your correlations are based on liquid and illiquid, because you can't sell the illiquid, you can only sell the liquid.
Sure.
So the correlation works until it doesn't work. When it doesn't work, it can be expensive and quite catastrophic.
Yeah. Now, I think, look, I'm sorry to interrupt you, but just to give you, I think today there is a large proportion of stock that display significant, idiosyncratic moves. And when you look at that, with more than 20% of the S&P constituent, are moving by over 20%, right? So there is a fertile environment, for certain strategies that are able to capture, those inefficiencies. I'm thinking about, equity risk premia, but also event-driven within the QIS space. And so, those strategies are at the frontier, are liquid alt strategies, and they are able, to navigate the mark-to-market within a certain criteria and rules. So it's very defined. And so we like, the way they behave. And we see that, with dispersion coming, there is a lot of these type of strategies that could able, to navigate some market microstructure stress. So this is the way how we are thinking, in order to build, I would say, consistent portfolio allocation today.
Great, thank you very much for that. Really appreciate the contributions here. So next question here, we touched a little bit upon the liquidity, but question 3 is what role should liquidity play in a resilient portfolio, and how are you balancing the need for flexibility with long-term return potential of illiquid assets such as private market infrastructure and real assets? And perhaps Alex, you might be best suited, given what you expressed regarding your portfolio, to talk a little bit about the aspects of illiquidity versus liquidity given your portfolio.
Sure. I mean, I think, like I said, for us, we're again backing up and kind of reiterating what I was saying before, right? we see kind of different parts of our portfolio or our strategy more for different tools to do different things. And very much so when we're looking at, let's say, our long-term time horizon, then we're much more focused on illiquid assets, real assets, whether or not, again, I'm focused on the tech side. So, that's directly into kind of more venture or private equity style investments, but also we're in a number of real estate investments. We're in a number of kind of resource, oil, gas, energy investments. And anything that we're looking at for kind of, 8 to 10 year time horizon. They often talk about, the illiquidity premium, but for us, it's just sort of, part of the game. It almost, let's say, the illiquidity almost forces us to stick to our strategy because we wouldn't be able to sell anyways. So it really matches what we're trying to do. Whereas I think on the liquidity side, the way that we look at it is more in terms of cash flow and seeing that, like, okay, what are different assets, sort of operating businesses and so on and so forth that are delivering us cash flow on a regular basis so that we can either, take advantage of new conditions, if we can, take advantage of new opportunities as they come about. And I think, again, a little bit of I think Todd was mentioning this is, we're looking at this as increasingly, I think portfolios are becoming more complex, where you need different things to do different tools for different functions, right? And instead of kind of looking at this as an overall kind of portfolio, you're looking at this like, okay, I have these investments or other things designed for this outcome, and I have these other things designed for a different outcome, and those will have different strategies and so on and so forth. And I think you need to understand what is the role of each of those in your strategy and what are you trying to do with them, and not to kind of mix them up. And again, I would say on a very high level, what we are doing is our liquid is usually kind of cash flow generating, so, assets, often businesses or real estate. And then our illiquid is more for long-term, more for stuff we're going to buy and hold. And essentially we're kind of executing on essentially kind of strategic, almost hypotheses or strategies of, what do we think will be important in the future. And I would say, at least on the tech side, being more concrete, 3 areas that we're heavily invested in and are ones that we don't think are going away anytime soon. And you can, argue with me or not, but that's basically health, food, ag, and energy. We believe pretty much no matter what, people are going to need to be healthy, fed, and energy for their needs, regardless of the rest of the climate. And so we believe those are 3 pretty safe areas that, are going to be highly valued 5, 10, 100 years into the future. And maybe, the details will change, but the need will not.
Got it. No, that makes perfect sense. Really appreciate it. Todd, I don't know if you've got some investments in the energy side as well. Maybe if you want to add a few words to this point.
That's right. I mean, we do concentrate on oil and gas quite a bit, and we really concentrate on 3 areas. You have metals, oil and gas, and then real estate, and then obviously on the media side. But I mean, our view is that liquidity can be actually a drag on performance, but in volatile markets like we're seeing now, it creates optionality for us. So we're looking at it that with illiquid assets, there's nothing wrong with them. Private equity, real estate, I mean, those are great holdings to have, but you need to create a liquidity budget to help with rebalance, deploying assets, meeting needs if you're running a family office. So that's critical. And so what we look for is if you do have illiquid assets, perhaps it's providing income for us and it's helping us with that liquidity budget. So that's a big focus in our area and in our office. So we want to make sure that we can take advantage of volatile markets like we've been seeing this year. I don't see that slowing down anytime soon.
No, absolutely. I think that's a fair observation. Great, thank you very much. So just in the interest of time, moving on to question 4. So question 4 is about downside risk, and the question is, when managing downside risk, how do you decide between structurally defensive allocations, so your fundamental allocation, versus more active hedging strategies, and what trade-offs do you sort of incur in each of those allocations? Todd, I don't know if I can carry on with you for this question, please.
Yeah, absolutely. I mean, we're looking at this as structural defenses versus tactical hedging. So think of your structural defenses as your core holding in your portfolio. These are your core assets. These are the ones that are going to perhaps produce income for you. You know you're never going to get rid of. We were talking earlier about long-term time horizons. Those are your core holdings. Structural defenses, that's how you're going to build that resilient portfolio. But the tactical hedging helps as far as how we look at our portfolio, because we want to know if we can take advantage of those volatile moments. So for us at Crosscheck, it's really important to make sure the portfolio is structural resistant at that point, and then being able to incorporate those hedging strategies, try to provide some additional income. The real trick, though, I mean, when you really comes down to it, is you have this liquidity issue. You want to make sure you're liquid. You can rebalance when you need to, but you have that balance where you're trying to make sure you're liquid, but you also have to be efficient. You have to have an efficient portfolio, and I think that's where the hedging strategies can come in. That, at least for us, that has helped, and we can take advantage of these moments of the volatility. I'm sorry if I'm repeating myself, but it's pretty straightforward as far as what we're looking at. From an oil and gas perspective, obviously with oil crossing the triple-digit mark yesterday, that has helped in a number of ways. I mean, one, you can look at futures contracts, but you can also look at core holdings such as companies like an ExxonMobil, for example. So that's your structural defense. That's going to help us be resilient no matter what happens with the economy and/or markets.
Great. Thank you very much for that, Todd. Very, very insightful. Moving on to question 5, which is sort of in a similar vein. So this is about stress testing. So the question is, how are you stress testing portfolios across different economic scenarios, such as sustained inflation, recession, or stagflation, which obviously is quite relevant, and what insights have most influenced recent portfolio adjustments? Alexander, I don't know if I can ask you to take the lead on this question. This might be relevant for you.
Sure, absolutely. So I'm returning a little bit about the last question, the way we embedded into our portfolio, I would say the convexity effect, why convexity today is very important, relating also, to stress testing across multiple regimes. We should first ask our question, why traditional portfolio struggle, for example, in a certain regime? So are we in a stagflation regime or not? So in a stagflation regime, I would say traditional portfolio rely more on equity premia and falling discount rates. And this work when growth is strong and inflation is low or declining, right? But in a stagflation regime, this relationship completely breaks. In a stagflation regime, growth is low, inflation rise, interest rate could rise, and discount rates ultimately rise. So the result is you have equity suffering, bonds also suffering, and so 60 portfolio, struggling, within this scenario. So now, if we goes into a stagflation scenarios, which the typical environment is rising commodity pricing, slowing economic growth, monetary tightening, which asset will perform, in a way. And so commodity should perform strong. Gold, also should perform strong. Energy equities should perform strong, and bonds should do very poor. And growth stocks, should suffer, like in the 70s. So coming back to the stress testing, for us is a very important mechanism when we implement, portfolio allocation. And we learned a lot, from participants from the past crisis, because of course you have leverage that migrates, you have, as we said again, the plumbing of the system that could change. So there is a lot of vulnerabilities, that triggered the last crisis, right? And the last crises are rarely, the ones that trigger the next. So that's why stress testing cannot be only historical, empirically. You should have a design where you are able, to understand, the exercise of the Eurozone crisis, the COVID shock, the inflation shock, you know, and those exercise, are useful, but they're not sufficient to us. So because the future will not resemble the past, in a way. So our approach is more different. We tend to look at stress testing as a systemic exercise. So we focus on the transmission mechanism, that could play, whenever there is, a break. And this, is probably the causal chain linking policy, but also liquidity, asset prices, leverage, and investor behavior. So
Great.
this is, something that we really look at, macro shock that gonna move asset prices, but also, falling prices that gonna tighten, funding conditions. And so, those funding, will trigger margin call and deleveraging. So there is probably forced selling that will amplify, price declines. And so all those tightened financial condition, could really play a game, when there is a stress. So we really want to have a correlation regime risk, because of course we all know that asset classes are positively correlating within the shocks. So we want to be able to navigate those regime without any mark to market, in the liquid world, of course. And then the microstructure with liquidity and augmenting selling pressure could come into play. So we really look at some microstructure stress. And the last point is the hiding short optionality that are embedded into certain strategies, such as carry, but also leverage strategies. So we need to capture those vulnerabilities within our stress test in order to understand if there is sign of break within our portfolio. And so this is the way we tend to really understand the market microstructure risk within our portfolio.
Great. Thank you very much, Alexander. Thanks for that. Just moving on to the last two questions here. We got 6 minutes left. So question number 6 is again about the correlation. So to what extent are uncorrelated or alternative assets still delivering meaningful diversification benefits? Where do you see diversification working, and where has it fallen short? Ian, this may be most up your strata, as they say. So maybe you can add a few words on this, please.
Sure. Despite everything I've said so far, actually on a personal level, I'm a glass half full person, not a glass half empty. So I'm optimistic at a personal level, but I think I'm realistic. I've worked my entire life in alternative assets, and the simplicity, the basic philosophical foundation of alternative assets in hedge funds was the ability to go short. And in most cases, that ability to go short was some form of arbitrage. So that was, if I thought that Shell was a better company than BP, and I wanted to take a hedge bet in the energy sector, I bought Shell, I sold BP. Now, that was a shocking thing for the traditional stock industry. They hated the fact that we should be allowed to short stock. They regarded it as illegal, immoral, and that we should have all been sent to prison. But we eventually won that argument. That in fact, more people lose money by buying stocks at the highest level than they ever did through the play of short versus long arbitrage strategies that the hedge fund industry brought in. So I've always believed in that, and I think it still stands up. What you do have to look out for, and I touched on this before, is that your correlation analysis stacks up as well. Now, I started my life as a physical metals trader, then as a precious metals trader, and as a market maker in metals and in foreign currency. So I've not just been on the investment side, I've been on the trading side. And I have seen in periods of intense volatility, liquidity dry up in the interbank foreign exchange market. Now that taught me a lesson, that liquidity can disappear. And particularly in a lot of the current strategies, which are basically gaining an advantage on a microsecond of trading, they create a false sense of liquidity, which totally disappears as soon as things go against them. So in that sense, when you're looking at alternatives, it's still, you can have a traditional hedge fund portfolio, but you are literally looking at things which are completely non-correlated. Now, having said that, I think the areas of interest in terms of diversification, and Alex touched on it before, are things people have to have. People have to have food, they have to have water, they have to have medical if they can afford it. And those are areas of great interest. So I'm quite heavily invested in solar, not so much in wind, because there's all sorts of different issues in wind that get quite complicated. But I'm also looking very closely at the efficiencies of traditional oil and gas as they decline in use. Because if you look at the transformation of the internal combustion engine over the last 60 to 70 years, they are much more powerful and can go much further on less fuel than they could. So on the basis that we cannot switch off the oil and gas and turn the world into a complete mess, we're going to have to phase them out. In looking at the alternative applications to those traditional assets, I think there are some phenomenal things. The same is true in AI, but then again, I'm not a generic AI investor, because if you ask me, is AI going to make a big difference in dog training? I don't know. But is it going to make a big difference in medical, where I am invested? The answer is absolutely yes. And I'm working at the moment with the creation of avatar doctors. So you can have a 24-hour online doctor who will be able to give you an analysis where not only based on you, but based on a fully understanding of some of your age and conditions, which a regular doctor would not be able to keep in their head. So I think there's some phenomenal growth opportunities, and that is an alternative place to be. The other is touching on lifestyle. As we know, all high streets are dying for a combination of reasons. So one of the things, again, I'm looking at is immersive experiences. I don't mean the things you wear around your head. I mean, actually, you'll go into a room, and in the morning, we'll do a kindergarten. In the afternoon, we'll be training classes. In the evening, we might have, I don't know, history or films, or you could meet all the world's greatest directors, because what we'll do is we'll download everything they've ever said and written. We'll create an avatar of them so you can interact with them. So these are things which are going to bring people back into the shopping center. So I'm not abandoning all of my long-term private equity investments. I'm just trying to shift them into the place where I think they offer me a real diversification and alternative and cash flow as well. But when the right buyer comes along, I'm selling.
Got it. No, that's very, very interesting insights there, Ian. Thank you very much. So we're at the hour now, but I hope our audience will stick with us for another 5 to 10 minutes, just so we can round off the last questions and maybe take any Q&As that there may be. So bear with us, please. So question number 7 here, and this is the final question for this webinar. So if you look forward, or as you look forward to the next 5 to 10 years, what structural changes in portfolio construction do you believe will be most critical for building long-term resilience in a world of ongoing volatility? I don't know if Alex, if I can ask you to perhaps take the lead on that, followed by Todd for sort of final remarks.
Sure. I think for me, the biggest thing that I want to get across here is that, so if you look at, let's say, the next decade, within the next decade, we're having a shift, at least in the private wealth space. We're having a shift where I think within probably the next 5 to 7 years, we'll have over 50% of the people who are actually kind of in charge of family offices being either the next generation or first generation kind of tech-minded individuals. And with this happening, I think the role of a portfolio as a tool is going to fundamentally change. And I think if you're going to start to see how the sort of new generations of kind of asset owners looks at this tool, that's going to kind of fundamentally change what the portfolio is. And at least what I believe and what you're seeing in a lot of areas is, Todd mentioned this before, of kind of, classic portfolio is kind of managing bonds versus stocks and so on and so forth. I think people are going to be looking at it, one, on a much more multidimensional way, but also I think they're going to be it from less of a kind of passive kind of wealth preservation tool to much more of a tool to help them achieve whatever their goals are and to have kind of a larger purpose in their lives. And I think when we start to look at this portfolio as, like, let's say, a financial driver to help you achieve whatever it is your purpose, and maybe let's say that's to feed the planet or heal certain diseases or whatever, I think it becomes a very, very different thing that is needed from the portfolio. And I think that's one of the biggest changes you're going to see moving forward. And that might remove some of the volatility question, right? It becomes less of a concern about the volatility if it's sort of like, okay, we need an economic driver to help us, let's say, cure cancer, for example. And I think that's one of the biggest changes you're going to see moving forward, at least from the private wealth side, is that you're going to have much more over the next kind of decade. I think you're going to have the tipping point where over the majority of the people running family offices are essentially going to be millennials and younger. And they're going to have just a very different mindset of what it means to construct a portfolio. And I think that's probably one of the biggest changes you're going to see within the next decade.
Great. No, very, very interesting perspective there, Alex. Todd, I don't know if I can hand over to you for sort of final remarks on this discussion here.
Yeah, absolutely. I mean, I think, first of all, I agree completely with those comments, because portfolio construction going forward is going to really be more focused on, or be regime aware, we'll call it. And so I think there's going to be stronger liquidity planning. You have so many other variables out there from a construction process that, in looking forward half dozen years ahead, I mean, these issues are not going to end. So I think as a result of that, we need to think about what's going to be in the best interest of the portfolio to try to optimize it as efficiently as possible. So, and that kind of wraps up what we were saying all along during this webinar, is that the times have changed since 2020 or before 2020. And so as a result of that, I think it's important. The liquidity, it seems to be a common theme right now for all CIOs and portfolio managers going forward. And it's probably going to stay that way, at least for the remainder of this decade.
Great. No, I completely agree with that. I think this sort of rounds up the time that we had, and it rounds up the question that we wanted to ask of our panelists. So I don't know if we want to go to if there's any questions from the audience before we round off. It doesn't look like we have any, so I'll just round off by saying, first and foremost, thank you to the audience for listening in to this webinar. That's greatly appreciated. Thank you very much to Marcus Evans for arranging this. And last but not least, a great thank you to our panelists for participating and for all of their great insights. I've certainly enjoyed listening to all of the various perspectives during this hour, and I hope our audience has as well. So thank you very much.
Thank you.
Thank
We'd
you,
also
everybody.
like to thank the
Thanks.
audience and the panelists for these great insights. Audience, just to let you know, a survey will pop out on your screen. It's just to Marcus Evans to know, would you like to know more? What other webinar topics would you like us to proceed with? And if you want to see it in on demand, you can watch it in the next 2 hours. Thank you so much, everyone. Enjoy the rest of the day.
Thank you. Bye-bye.
Thank you.